Concerns that the U.S. economy is about to enter a recession have been raised in response to the Federal Reserve's aggressive efforts to raise interest rates. But there might already be one important industry there. As the Fed stops supporting the economy, the housing market has cooled to the point where some analysts believe it may be in a slump. The first half of the year saw a nearly doubling of mortgage rates. What's good, you guys? This is Market Thrive, and today, we're going to talk about why the number one US housing market is currently struggling. Before we start the video, I would just like you to do me a favor by just hitting that subscribe button and the bell notification down below to keep you updated on this channel. So without further ado, let's hop into it. The possibility of a severe downturn that could cause home prices to plummet has been raised by the Fitch Ratings service. Beginnings of housing fell in July. According to census data, new home sales last month were down 30% from the previous year, and builder confidence has dropped to its lowest level since the financial crisis of 2008. That's significant because the housing sector typically leads recovery efforts, and spending on housing can make up as much as 18% of GDP. Therefore, even though the Biden administration touts the health of the labor market and the resilience of consumer spending, a protracted decline in the housing market could exacerbate any impending recession for the American economy. Home ownership has long been a key component of the economy because it is the main way that most Americans accumulate wealth. During the pandemic, it gained more significance, calming the unrest as white-collar Americans fueled demand by looking for larger homes amid lockdowns and work-from-home policies. The surge in home purchases was fueled by historically low mortgage rates, and homeowners rushed to refinance their loans to give themselves a more secure financial foundation to withstand COVID-driven volatility. Even though home prices dropped last month for the first time in 3 years, they are still higher than they were a year ago because of the pandemic's explosive growth. However, many prospective buyers were priced out of the market by the increase in mortgage rates brought on by the Fed's rate hikes. Goldman Sachs economists predict that home price growth would slow sharply in the next couple quarters and fall to 0% in 2023, in a note warning that the housing market has further to fall. Sellers have reduced their asking prices as a result of the declining market. Redfin reports that in July, price reductions affected more than a fifth of the available homes, the highest percentage since the company began keeping track of the information in 2012. Quote, house prices were elevated going into this monetary policy change, and this is a big interest rate shock we're seeing, end quote, said Brian Colton, chief economist at Fitch Ratings. Quote, we're heading into a monetary tightening-driven slowdown, and housing is going to be affected by that more than the economy overall, end quote. In order to combat inflation, the Fed is also reducing the portfolio of assets it purchased to boost the market, according to Colton. No one is really sure how bad it will get at this point, he added. By purchasing mortgage-backed securities in a process known as quantitative easing, the central bank had injected nearly $3 trillion into the mortgage market. It is currently letting those securities mature and leave its balance sheet, but it has also left them available for sale in the event that it decides to do so in order to reduce its portfolio size more quickly. According to Douglas Holtz-Eakin, a right-leaning economist and president of the American Action Forum, the market will not be attractive. He recently testified on the subject before the Senate Banking Committee. Quote, housing is going to be disproportionately bearing the brunt of this disinflation, and the next couple of years are going to be tough, end quote, Holtz-Eakin, who formerly headed the Congressional Budget Office, said in an interview. However, senior economist at Zillow, Jeff Tucker, asserts that things could be worse. Tucker noted that as sellers start to second-guess listing their homes, inventory growth has leveled off in recent weeks. 2.8% less new listings were added in July, according to data from Realtor.com. The Fed's ability to control price growth and whether doing so causes the general economy to enter a recession will determine what happens next. On Friday, Fed Chair Jay Powell issued a warning that the fight against inflation would hurt some businesses and households. There simply aren't enough homes for everyone who wants one, so demand is resilient. Once inflation declines, she predicted, mortgage rates will drop and housing demand will pick up. Despite an increase this year, the number of existing homes for sale is still below pre-pandemic levels. Here is one instance. After years of sharp price hikes and intense competition to buy a home amid the COVID-19 pandemic, The Texas housing market is starting to slow down. Buyers who competed for a small number of homes in the past typically had to pay more than the asking price and submit offers straight away. There are now more homes for sale in Texas than any before since the state's pandemic housing scarcity began in fall 2020. Home sales in Texas declined by more than 5% in the 3 months from April to June compared to the same period the previous year. According to data from the Texas Real Estate Research Center, the urban areas of Dallas-Fort Worth, Houston, and San Antonio all had similar reductions. In Austin, home sales have fallen more noticeably by 12%. Many sellers have also cut their prices in an effort to attract buyers who are struggling with rising mortgage rates, inflated housing prices, and inflation. According to real estate specialists, this indicates that buyers are starting to have the upper hand, according to real estate specialists. According to Elizabeth McCoy, a real estate agent in Fort Worth, quote, "It's still a seller's market," end quote. However, we can see that buyers now have a little bit more options, and that's very wonderful. That represents a significant change from the pandemic's peak when record low mortgage rates and an increase in home-based employment spurred purchasers to buy homes so quickly that the state's supply collapsed and home prices increased an average of 28% from the beginning of the epidemic to the end of 2021. This included millennials who had put off becoming homeowners. The pattern has started to reverse across the state since the Federal Reserve started hiking interest rates in the spring to try to slow down rogue inflation, which also drove up mortgage rates. According to the Church, 55,668 houses were up for sale in Texas in July. That number had increased by more than 50% to 83,513 a year later. The number of properties listed for sale increased by double digits last month in San Antonio, El Paso, Houston, and the Dallas-Fort Worth Metroplex, while fewer homes were sold overall. In comparison to the same period last year, fewer homes were sold in each metro region during the first 7 months of this year. The property market in Austin, where it was already hot, was particularly hard struck by the epidemic, culminating in May when the median price for a home reached $550,000, up from $305,000 in January 2020, right before the pandemic started. There is still an imbalance between the number of homes available for sale and the number of buyers. A 6-month supply of housing, or the time it would take purchasers to buy every home on the market, is what residential real estate professionals consider to be a good balance between buyers and sellers. The Texas Real Estate Research Center estimates that as of July 1, Texas has 2.5 months worth of supply. After a 2-year development boom, builders in several areas of the state decreased the number of new single-family houses they were constructing. Building permits for new single-family homes in Texas fell by double digits in July compared to July 2021. Fewer people were looking to purchase homes. According to Mike Dushberger, the upcoming president of the Greater Houston Builders Association and the developer of townhomes in Houston, asserted that his business has recently seen a rise in potential purchasers who are eager to flee the state because of the soaring rents. As of January 2020, rentals have increased by more than 21%, up 12.4% over the previous year as a result of the state's hot housing market during the pandemic. In Austin, San Antonio, and the Dallas-Fort Worth Metroplex, fewer building permits were requested in the first 7 months of this year compared to the same period last year. As a result of the state's planned population and job growth, housing demand is expected to remain strong, albeit less so than it was at the height of the pandemic, as a result of which, despite the downturn, renters who want to purchase a home will still pay more than they would have before the outbreak. The traditional entry-level properties for first-time buyers, which cost roughly $250,000, are much tougher to obtain nowadays. According to Dean, as construction costs grow, fewer new homes in that price range are being built each year. McCoy, the Fort Worth real estate agent, says that all of this makes it harder for a first-time buyer to buy a home. So how long do you guys think it will last? If you like today's content, you'll sure love our previous videos similar to this on the reason why the US housing market crashed, which you can find in the description below. Feel free to jot down your thoughts in the comment section below. If you enjoyed today's video, please leave a like. And if you want to stay updated on our posts, hit that subscribe button as well. Once again, this is Market Thrive signing off.